Torres Strait Islands joining us today. I hope you enjoy the program that has been put together, centering on the theme, Advancing Your Operative Techniques, Improving Your Skills. We'll hear from some fantastic speakers throughout the day, including Professor Michael Solomon, who will be presenting the RACS 2021 Henry Windsor Lecture. We'll also hear from some high quality free research papers throughout the day. One of the presenters today is Professor Paul Smith, and it's my pleasure to take the opportunity to thank Paul for his dedication and contribution over the past 2 years as the chair of the RACS ACT committee. I'd like to thank our sponsors for today, our gold sponsor, W.L. Gore and Associates, who will give a brief presentation later in the day, our silver sponsors, Avant, Sanofi, MIGA, Medtronic, and our supporting partner, the Bongiorno Group. So the Bongiorno Group were to present a face-to-face meeting at the breakfast seminar. Therefore, they're going to start the meeting with a brief presentation on some critical changes in the insurance industry. So getting us underway is going to be Michael Waycott, who's provided accounting and consulting services to dental and medical professionals since 1998. And as a director of the Bongiorno Group, Michael is a regular speaker with the Royal Australasian College of Surgeons, the Australian Society of Anaesthetists, and the General Surgeons of Australia. Michael presents at various conferences and workshops around Australia, discussing topics pertaining to finance that are relevant to all medical professionals. Please welcome Michael.
Thank you, Hari, for that kind introduction. I'd just like to firstly thank the college for allowing us to speak at the ACM. I'm ASM. I'm really disappointed we couldn't speak in person. However, I'm sure you've got a jam-packed day. I'm just sharing my screen and get the presentation underway. So look, very, very happy to be part of the College of Surgeons ASM today. And I hope you get a little bit out of the talk I'm about to provide. Let me just go back. So what we're covering today, just quickly in the allocated time slot that I've got, is there's going to be lots of surgeons out there in private practice, and some surgeons who may have recently obtained their fellowship and going out into private practice. And the question always comes up when I'm consulting with surgeons as to what is the best form of structure to operate my private practice under. And so really what I've got on this screen here is just to show you your different options. And practice company, discretionary trust, or self-employed. And I'll get to group practices shortly. But look, there wouldn't be a session that I provide where I don't get questions on the most appropriate structure to operate under. And I'll just make this point really clearly. It doesn't matter what structure you operate under. It's the treatment of the income that's the most important. Now, all your income as surgeons that you generate is income from your own personal exertion. So the treatment of that income in the options that I've got there on the slide, a practice company, trust, or self-employed, is absolutely critical. So with a practice company, the Commission of Taxation is really clear that in order for you to trap the income, in other words, your income less the expenses, you have a profit, tax rate on a company is 30% rather than, say, 47% as an individual. In order to enjoy that low tax rate in a company, you need to be treated as a business. And I've never come across a solo surgeon operating through a company that has been able to prove to the commissioner that it is actually a business. So really, the profit needs to be zero. It's not a shield for patient litigation. So if there's any sort of patient litigation, they're going to go after the doctor individually, not via the company. So really, it doesn't provide any great advantage at all operating through a company. Once upon a time, there was superannuation advantage, but that's all gone, and tax deductible contributions can be claimed as a self-employed individual, so it's fine. The same as a trust, discretionary trust. If you're operating your private practice through that trust, a lot of structures I've seen over the years where the practice is able to, well, I've seen that the beneficiaries of the doctor might be receiving distributions of profit. So you need, again, to be treated as a business in order to enjoy the profits being distributed to lower taxed hands from your patient fees, less your expenses, out to lower taxed hands amongst your family, wife, children, mums, dads, and so on. So again, very unlikely for that solo surgeon to be able to be treated in that trust as a business. So again, 100% of the distribution goes back to the doctor. This may raise some questions in your own mind. Gee, am I operating under the right structure? Well, it's probably time you have a look at that. And those that are starting out in private practice, certainly you need to sit down and have a chat with your accountants and advisors to make sure that you're getting the right advice. So the third dot point there, self-employed. Look, this is the way to go, guys. Keep it simple, okay? KIS, 1S. And operating through a self-employed individual, you apply for your own ABN, you're on the pay-as-you-go installment system, and you don't need any other structure, a practice company or a trust operating your own private practice. So I couldn't be any more clearer than that. My details will come up on the last slide. If you've got any questions regarding this, more than happy to answer your questions via email or a phone call. Group practices are a little different. Some surgeons will set up group practices where they're sharing rooms, and it's just a cost sharing arrangement basically. And the entity that pays all the operating expenses shared by the surgeons sharing the rooms might be a trust. There might be a partnership of trust, and each of the surgeons pay a service fee to cover those expenses. And you may have a markup in that, and that entity, the service entity, makes a profit. Okay. Now, I've just got that last point there that those that are starting out in private practice, there is a tax honeymoon. So you really need to ensure that the income you're earning, those that might be winding down their public work and picking up their private practice, that the money doesn't burn a hole in your pocket and you commit financially to buying property as such. The pay-as-you-go installments will kick in once you lodge your tax return with that private practice income in there. So there is, I could go on and show you a slide, but I don't have the time today. If anyone wants to talk about what is the tax honeymoon, by all means, give me a call. So that's structures, and I'm just conscious of time. So that's structures. Now, there are some, I'll just move on to risk insurance, and oh boy, absolutely. There are some amazing changes that are afoot to come through in the risk insurance industry in this country. And as you know, being in private practice, something goes wrong, either medically or you've injured yourself and unable to work, being self-employed, you don't work, you don't get paid. It's as simple as that. Unlike a public position where you might have accumulated sick leave within the employment arrangement that you have at one of the hospitals, you're able to utilise the sick leave that you've accumulated. When you go out into private practice, it's a different story. You don't work, you don't get paid. So I'll just take you through. This all relates to income protection. We've got massive changes coming through in the risk insurance industry, and they look like they're coming through in October this year. And look, the clock is ticking. Once I go through this, those that haven't done anything about their income protection, you've got to do it now. Those that need to increase their income protection to be in line with their current earnings, you need to do it now as well before that date. So currently, income protection policies generally cover you for 75% of your income. Divided by 12 is your monthly benefit. And there's income thresholds throughout. So it's not 75% of $1 million if that's what you're earning. There are certain income thresholds where it drops down to 50% and then 20% of the excess. So the premium types, currently there's level and step premium. So the difference between those, I'll be really clear, and if you might want to jot these down. So the difference between a level premium and a step premium is a level premium is linked to inflation. And so I just shut the shutters, bit of sun shining on my face. The level premiums are linked to inflation, where it goes up with inflation each year, and the step premiums are linked to age. So the older we are, the more risk we are to the insurance company of having a claim. So therefore the premium is in line with the age that we are. Statistically, Like the age, I'll give you an example. A 55-year-old male on a step premium is a higher risk of having a claim statistically with an insurance company as opposed to a 40-year-old male. So therefore the premium is going to be much higher than at a 55-year-old than a 40-year-old. So the benefit, I've just skipped down to the benefit period. So the benefit period as own occupation. Now this is fundamental right now. Those that have I'll just make the point now, those that have policies currently, they are all grandfathered up to this point. So the changes that are coming through in the 1st of October, which I'll show you shortly, are not applicable to your current policies. It's only policies written after that date of 1st of October. So the benefit period to age 70, own occupation, what that basically means is you're an orthopedic surgeon, you've had a car accident, unable to work, possibly ever, okay? You might have a brain injury. That monthly benefit kicks in and you receive that monthly benefit if you're alive every month up to the age of 70. Because it's an own occupation, you can't fulfill your duties, your professional duties as an orthopedic surgeon, therefore you continue to receive your monthly benefit. So these are the changes that are coming through. And what they're doing from 1st of October, the benefit amount is going to drop from 75 to 70%, no add backs. What does no add backs mean? Okay. So currently, if you've got an income, taxable income of 300,000 and you contributed the maximum super contribution of 25,000 last year, they would add that back to your taxable income currently. So your monthly benefit would be based on 325,000. From 1st of October, they don't add that back and you drop 5,000. So on that 300,000 example, your monthly benefit reduces by 40,000 per annum. So that's 3,333 per month, which is significant. Just skipping down, it looks like they're going to change the premium type that you can choose after the 1st of October, and that will be stepped only. So the premiums are really going to increase substantially as the older we get. And keeping these income protection policies is absolutely important because you need to match your risk with the level of risk you're taking on. When I mean level of risk, that is your debt levels, okay? And the private school fees that you have and the living expenses that you have. So if you don't work and you're self-employed, who's going to cover all those operating expenses that you have, financial commitments with banks and so on, school fees, living expenses. So even though they're changing these, the risk insurance, it's absolutely critical that you keep them. Now, the real sting here down the bottom is the benefit period. Now, what's on the table? So these are all on the table right now. We don't know for absolute certainty that these are going to come through, but the noise is getting louder and it's more than likely that they will come through. So the benefit period may change after the 1st of October 2021 for all new policies written after that date, not ones that have been written prior. Remember, they're grandfathered. So if you're on long-term claim, like the example I used for the orthopedic surgeon, then 2-year benefit period will kick in. So what that means is after 2 years, your policy will revert to any occupation, okay? Any occupation. So basically what that means is, could you be trained in another field of medicine, whether it be a physician? Could you actually work as a receptionist? That's how ridiculous it could work out to be. And the maximum age you'll be paid to is the age of 65. So these are really, really significant changes. And the action that you need to take is to ensure that my policies are up to date. There is one further one, and that is this is on the back of all these changes coming through, is on the back of the major change that policies in income protection on the 31st of March 2020. Now, what they got rid of then was the endorsed and agreed policies. Endorsed and agreed policies basically mean at the time of application, you've supplied substantiating information that says that the monthly benefit that you're applying for is correct. And so at time of claim, say 10 years down the track, you might be earning less, no questions asked when you have your claim lodge your claim with the insurance company as you've substantiated your income some 10 years earlier. That's all gone. Any new policies written after the 31st of March will be what's called an indemnity policy. Basically, what that means is you need to prove your level of income at the time of claim. Now, an indemnity policy, as you can see, is the best 12 months in the last 3 years. That's what it currently is. After the 1st of October, it's just the last 12 months. So if your income, you're paying a monthly benefit on an income that might be higher than what you're earning at the moment, you're only going to receive what you're earning at the moment. So that's a big difference, okay? Now, as you can see down the bottom there, the life, trauma and total and permanent disability, there's no changes to those at the moment. Why are risk insurance companies making all these significant changes? Well, I'll tell you why. They've made approximately $1.4 billion loss over the last couple of years. Basically, they've paid out more than they've received in premium, okay? Now, the good news is, this is all doom and gloom, but the good news is those that have currently an endorsed and agreed income protection policy, and you mightn't have looked at it for the last couple of years, and your income has increased and your monthly benefits about here, this is where it should be, you're able to go back to your advisor and increase your monthly benefit to what it should be based on the earnings you are today. And that increase will be increasing your existing policy that enjoys all the current benefits that you've got. It's endorsed and agreed. It doesn't have these changes in there. We don't know how long that's going to last. So the important thing is to act now, make sure that you make sure that you have your income protection monthly benefit in line with your current income. So I'm just conscious of time. So the structure, I just want to summarize really quickly. So the structures: company, trust, operating a solo practice, operate as a self-employed individual. Watch the tax honeymoon for those that are coming out into private practice now. Your risk insurance changes, they're enormous. We haven't seen changes like this ever. And it's time to act. If you haven't done anything about your risk insurance, I can't stress it enough. If you're going to go to the trouble of taking out risk insurance, you want a blue ribbon policy. That's not blue ribbon after the 1st of October, but it's something, okay? So here's my details. If anyone's got any questions related to today, there's a couple of questions through the chat box. I'm not going to be able to get to them. I hope if the college can do me a favor and just keep those questions. I'm more than happy if you supply your email addresses to respond to you via email. Anyone wants to contact me, I'm more than happy to go through any questions that you might have. That's it. I hope I got through that quick enough. Thank you, Hari.
Thank you very much, Michael. That's very interesting and relevant to our delegates, especially for future planning. So thank you.